Hello class, welcome to this chapter 8 handout answers video. Hopefully you've had a chance to work through the handout with help from your book. Get stuff going on there. Let me share my screen here and we'll get right into it. You're going to need the handout from your modules. Okay, first thing we got going on here. Stanley Electronics purchased 1,700 TVs for resale, 525 each. So if they're buying something and they're going to resell it, what are they purchasing here? They are getting inventory. Okay, so record the journal entries on June 18th and 31st. Again, kind of like in my previous videos, I'm not going to go to the journal sheet here. If you have the journal sheet printed out and you want to use it, that is great. If it's a great learning tool, but you can also just write it up here without having that in. So on 6/18, we are going to make a journal entry. At this point in time, we bought the TV, so our inventory increased. And that amount would have been $892,500. So I'm going to make a debit to my inventory. Okay. 1,700 times 525. That's at $892,500. Okay. We're not going to pay for it at this point in time, so that we are going to create a liability or a credit to an accounts payable for the same amount. Okay, 7/31, we make the payment. So now we can debit our accounts payable to take it off the books because we no longer owe it. And since we paid it at this point in time, paid is key for cash going out, so we can credit our cash by that amount. And that is how you record that simple general accounts payable liability. Okay, next one has a little bit more to it. So here we bought some inventory on credit, and then we decided we cannot pay within the normal payable amount time. So we asked to extend it to a note payable, which comes with interest. Okay, so on 4/15, our initial journal entry, since we were buying inventory, we would debit our inventory by $1,340,000. And at that point in time, we would have an accounts payable for the same amount. That would be on 4/15. When we get to 5/31 now, we cannot make our payment. It's due right now. We cannot make it. We ask them to change it to a note. They agree. So at this point, we will just debit our accounts payable by the $1,340,000, and we will credit a new liability of a notes payable. Okay, it's doing the same thing. It's just changing the wording around. We're taking it out of an accounts payable and putting it into a note payable. Okay. Then on 11/30, okay, we go to pay it back. So we know we can debit our notes payable by $1,340,000. I don't know if you guys can see that lines dropping when I write or not, but I can. Okay, at this time, we're also gonna have to record some interest expense that comes with the note. So to do that, we take the $1,340,000 times 12% times by however long the note was based out of a year. So if we signed it on May 31st and it went through November 31st, we had all of June, July, August, September, October, November, 6 months, 6 out of 12 or 1/2. Okay, that equals 80,400. So that's what we'll put in as interest expense. I don't know why the board is doing that to me, but it's pushing everything off to the right. We add those two together, and that's what we're going to credit for cash of $1,420,000, and that's the amount that's going out. Okay, so that's taking an accounts payable, turning it into a notes payable. Next here, let's see if we can do this. Let's change this question around here a little bit. We're going to make that into Friday, okay? Monday through Friday. During the current year, December 31st falls on a Tuesday. Okay, So now we're gonna make an adjusting entry. We know we're going to have to debit a wage expense and credit a wage payable. Okay, we learned this back in chapter 3 when we were talking about this matching expense. We got to put those 2 days in this reporting period. We got to put that 2 days expense onto our income statement. In order to do that, we make that accrued liability of wages payable. Next, we have to determine the amount. Okay, so we have 20 employees. Okay, we're going to work for 2 days, $10 an hour, 7 hours a day. Okay, and I got that 7 hours a day because it's a 35-hour work week. And they work Monday through Friday. They work for 5 days, 35 hours a week spread evenly at 7 hours per day. So 20 employees multiplied by 2 days at $10 an hour, 7 hours a day. We get 2,800. So we would just take that number and put it into our journal entry. You have wage expense for 2,800 and a wage payable for 2,800. Okay. Excuse me. Next, Betty's Antique Shop, especially antiques from the 19th century, sold a chair from the Civil War area for $60,000 on account. Then we have some state sales tax and an excise tax. Reported journal entry, record the sale. Well, set on account, so I know I'm going to have an accounts receivable. Okay, we made a sale on account, they're going to have to pay us, but we don't know how much exactly yet. First, I know I need to credit my sales revenue, and that is going to be the amount that we sold it for, or $60,000. We're also going to have a sales tax payable. Okay, and that is going to be in the amount of $3,000. And you get that by taking the 60,000 that we bought on account multiplied by the 5% sales tax. There's also a $400 per antique federal excise tax. We'll call that federal excise tax payable in the amount of 400. And then when you add them all up, you can see our accounts receivable should have been debited for $63,400 because that is the amount that the customer is actually going to pay us, even though only $60,000 was the sales price or the revenue. Here, we're going to do 2 separate things. First, it's only asking for the necessary journal entries to record the payroll taxes. It says round to the nearest penny. We're going to round to the nearest dollar. Okay. It does not ask for the withholding amount, but I'm going to show you, we're going to go through how to journalize both. Okay. Withholding is actually what's going to happen on payday. Okay. So on payday, we have gross payroll of $25,000. So we are going to call that wage expense. Okay. That's what our employees earned, was $25,000. From our employees, we need to withhold federal income tax, state income tax, and then the FICA, the Social Security and the Medicare. Okay. So it says we must withhold federal income tax of $2,400. So we'll say that's federal income tax payable. We are taking it away from the employees. We are holding it to pay the federal government. So there's a liability that we will pay off later. Then has state unemployment tax. Okay, that is not a withholding because it's not an income tax. The unemployment tax is part of the payroll taxes that we'll do in a little bit. It says assume the entire payroll is eligible for Social Security and Medicare at standard rates. Social Security rate is 6.2%. Medicare's rate is 1.5%. Okay, those are constantly changing with whoever's in charge of the government. That's what it is currently. That 6.2% gets paid by the employee and the employer. Okay, the 1.5% gets paid by the employee and the employer. They are both paying that FICA. Okay, so we're gonna have Social Security payable and Medicare payable. Okay, for the Social Security, I take the 25,000 multiplied by the 6.2%. And I get 1,550 and 363 when I take the 25,000 multiplied by the 1.45%. Okay. What is remaining here in order to make our journal entry balance is the cash payment. So even though our employees earn 25,000, they are only receiving cash of 20,687 because of the income taxes, Social Security, and Medicare coming out. So for payroll tax here, we are going to have a payroll tax expense. We don't have to worry about the income tax, but we do have a state unemployment tax, okay? That's the SUTA. State unemployment tax, that is payable at $75. And remember, we also have to match the Medicare payable and the Social Security payable of 1,550 and 363. And all these are additional payroll tax expenses that we calculate after we have everything that we have. We created all our payables. We can do a payroll tax expense of the total amount there of 1988. Okay, so really important here to understand the difference in payroll and withholding, payroll taxes and withholding. So remember, into withholding goes any income taxes, Social Security, and Medicare. Into the payroll taxes goes unemployment taxes, Social Security, and Medicare. And finally, we have a question here on unearned revenue. So in part one here, make the journal entry to record the prepayment of 720. But when they prepaid, we received cash of 720. And here's where we create our liability of unearned revenue, 720, because we have to do the work for them later. Okay, we're gonna have to go clean their carpets at some point in time. Two, when we clean the carpet one time, we are going to remove some of the unearned revenue with a debit, and we are going to credit our service revenue to get it onto our income statement. And since they paid 720 for 15 carpet cleanings, we take the 720 divided by 15, and we find out that each time, each carpet cleaning is worth $48. So that is the amount that we will move out of unearned revenue into service revenue. And we will do that out for 15 times. We'll make that same journal entry every time we go and clean that carpet. All right. So hopefully we're able to work through those. Hopefully these explanations helped anything you did not understand as you were trying to work through those. You should be able to get through your chapter 8 homework now. Be prepared for exam 3. And as always, if you have any questions, do not hesitate to reach out to me. I am here for you. Have a great day.